Welcome to etvFutures.com. Today is Tuesday, March 11th. I'm Caitlin Sisney with your Commodities Open. After hitting a record $109 a barrel earlier today, crude oil retreated after the Federal Reserve said it plans to lend up to $200 billion of Treasury securities in exchange for debt. The dollar rebounded from a record low against the euro on the Fed's announcement. Crude is trading at $106.86 per barrel on the NYMEX. Natural gas followed the price of crude down from a more than two-year high. Gas earlier rose to $10.139 on the New York Mercantile Exchange. Gas has advanced 33% so far this year. Natural gas is trading at 9.965 per million British thermal units. Following the Fed announcement, gold made minimal gains. Gold is trading at $975.90 per ounce. Meanwhile, silver is trading at $19.74 an ounce. Today we're joined by Mike Fitzpatrick from MF Global. Mike will give his outlook for the energy market.
Hey, good morning, Caitlin. As you see, energy prices pushed up to new highs in the overnight session and just before the market opened for trading this morning, scoring a high of 109.72 before failing back. I think that's probably one of the main reasons that it did fall back was because it didn't punch through the 110 area. Technicians, once markets push into new territory like this, use milestones that are pretty easy to recognize: 105, 110, 115, like that. So not being able to post that 110 caused a lot of the holders of length with low resolve to leave their positions, and that's exactly what we created here in the markets. The market really is divorced from fundamentals for the most part, and is proceeding ahead on emotion. This buy the dips mentality seems to have gripped most participants in the market. So every time we pull back, more and more funds are loading in, and these not only include hedge funds who have been dabbling in the commodities markets for a couple of years now, but also the more conservative elements of the fund community, pension funds, college endowments, and the like. They see huge pools of their money coming in as well too. That's one of the main reasons that the rise is being fueled, because they're looking for a hedge against inflation at a time, also when the credit and equities markets are performing very, very poorly. So they need that return, and you can see even the fact that some of these items come out that really should have pushed prices lower. I mean, it's amazing that participants continue to discount the mounting signs of a slackening U.S. economic growth. Forecasts that for tomorrow's inventory report that crude stocks may expand by as much as 2 billion barrels have done nothing. I mean, the market also shook off this IEA report that shows 190,000 barrel a day downward revision in 2009 oil demand in most of the OECD countries, and that the supply there will actually exceed demand in Q2. The calming of geopolitical fears coming from a conflict in Latin America. None of these things have really pushed prices back too much. However, if the prices do end at a lower end of today's range, technicians will view that as a very bearish sign, and that the market had posted a new high and finished at the day's lows, and this may be the beginning of the end of the latest leg of this rally. However, no one should expect prices to go back down to historic lows. The global economy is such that China and India are here for the long haul. They're not going away anytime soon, and but that doesn't discount the fact that we may have a sell-off back to $90 or even lower.
Thanks, Mike. That's all for your Commodities Open. I'm Caitlin Sisney. Join us again later today for the Commodities Recap right here on etvFutures.com.